There is, I noticed that, and this is something that I think is a bit of an oversight, especially in the problems. There were no problems that I could assign in Connect that used what we call the simplifying conventions of depreciation expense, estimating depreciation expense. Most of them are asking you for the partial period. And so when we have a partial period, we are looking at, for example, in this one, I said logically, we apply an adjustment to the expense that was estimated for the full period. So if we acquired an asset on April 1st, then if we're a December 31st fiscal year end, we know that there are 9 months here. And over the course of these 9 months, then we will what we do in order to estimate the amount of depreciation is we get an estimate of the first useful year. So the first useful year now comes out to, it basically borders 2 reporting periods, right? It encompasses all 9 months in the year of acquisition. And then because it didn't fill up the full 12 months of its first useful year, there's, excuse me, 3 months left over in the following year. So we report at 12/31, we would only report the first 9 months. And so we make an estimate of the first useful year. If that is under straight line depreciation, $12,000 for year one. Well, actually, under straight line, it's going to be 12,000 for year one, year two, year three, year four. If this is my depreciation expense, straight line reports the same depreciation expense every year. But splitting this up then and only doing the partial period, I would take 12,000 and multiply it by 9/12 to represent these 9 months. And then in the next useful year, or I'm sorry, the same useful year for the next calendar year, then it would be 12,000 times 3/12 for that little chunk. Okay, so this amount would be recognized in the income statement for the year of acquisition. That amount would be recognized in the next year. So that's how partial works. The problem is when you get into different types of depreciation, they're not always so smooth. So for this particular example, I pulled out, and I believe that these, no, actually they might not. So basically I say that we want to adjust these estimates for an asset purchase on October 1st with the firm's fiscal year end being 12/31. So obviously with straight line, we got the same depreciation expense year after year after year. The sum of the year's digits is accelerated in the first year, so it recognizes more, much more than straight line, more than straight line, but not as much as the first year. It equals straight line, and then it starts dipping below. So these are all depreciation expense under alternate methods. And if I want to do first a partial period, then I will use these to determine how to spread it out. And I'll show you at least the first 2 or 3 years of useful years. So notice that this year 1, year 2, year 3, year 4, these estimates correspond to the useful year, not the calendar year. Because the calendar year, the useful years will overlap the calendar years. If I bought it on October 1st of one particular fiscal year, then it's 12/31. Then I have another later on October 1st date. Then I have another 12/31, October 1st, and a 12/31. So this would correspond to calendar year 1. This corresponds to calendar year 2. And this corresponds to calendar year 3. The calendar year tells me when my reporting, what I'm going to report for that period. So if I'm looking for the amount of depreciation expense that's going to be reported on the income statement, I want to look at it for those various calendar years. Now, like I mentioned, the useful year is going to really bridge two. For the first useful year, there's only 3 months here, so it also spans into the first 9 months of the second calendar year. This is useful year 1. And then the second useful year does the same. And the useful year is just on 10/1 because that's when we bought it. So that's useful year 2. And then useful year 3 would bridge over calendar year 3 and all the way into year 4. Something, nope, that's right. Sorry. It takes it a little further to do the calendar year 4. So I'll do 3 useful years to show you how this works. So for straight line, it doesn't tend to be much of a problem. The reason it doesn't tend to be a problem is for calendar year 1, how much depreciation expense am I going to want to record? So I would take 70,000. And because there's 3 months, October, November, December, 3 months, I would multiply it by 3/12. And so the depreciation expense for the calendar year, which is all I care about when I'm reporting on the income statement or I'm adjusting my books, is equal to 70,000 plus, or 70,000 times 3/12. And of course, I didn't make up a number that would work really nicely. So actually, it's not too bad. It's 17.5 thousand. So that's what I would report in calendar year 1 for my depreciation expense. Now in calendar year 2, I would have 2 calculations because I would have the useful year 1. It still has 9 months left, right? It has the time from 12/31 to 10/1 in calendar year 2. And then it has an additional 3 months, but that's the next useful year. Well, what's the depreciation expense in the second useful year? It's still 70,000 because we're using straight line. And so if you notice, or you can imagine, because 9/12 plus 3/12 gives me 1, I'm just going to recognize $70,000 because it's straight line. So partial periods don't really mess up straight line they can mess up the other ones because we're not going to repeat the same uh, the same expense for the second useful year as we did the first useful year. In this case, then we still got 70 times 9/12, which would be 52.5. Yep. And we would add to that, we already know what 70,000 times 2/12 is, it's 17,500. And so the depreciation expense for the second calendar year is going to equal 70,000. And that is using a partial period depreciation. It's going to be the same story for calendar year 3, because in calendar year 3, we'd have the same 9 months here times the second useful year's depreciation expense. It would be 70K times 9/12. And then the final 3 months would use useful year 3's depreciation, but because we're using straight line, it's still 70,000. And so this seems all very like unnecessary when it comes to straight line, and I agree to some extent it is, but I like to lay it out this way so that we get, with the simplest version of this, we get an idea of what we're doing, how we're apportioning the amounts as useful years change. Now, to see where this really comes into play, we'll look at the sum of the year's digits. So because this amount is the first useful year as estimate under sum of the year's digits, I would have 116,667, and that would get modified by 3/12 because we're in the first useful year for this period of time in the first calendar year. So the depreciation expense for the calendar year 1 would simply be that amount. So nothing's terribly different yet. We'll see the difference start to pop up in the next year. This one doesn't come out to be quite as round. It is 29,000, and I will round it. It's 166.75, but I'll just round it to 167. Now in the next year, we still have 9 months of this useful estimate, the first year's useful estimate. So it's 116,667 times 9/12. Okay. And that predicts or estimates the depreciation from 12/1 to 10/1. Notice this period is still in the first useful year, even though it's in the second calendar year. That's why we're using 116,667 as my depreciation estimate, 9/12. However, once we move past 10/1 in the second calendar year, we switch to the second useful year because it's been a year since we purchased this item. So now we apply 3/12 from 10/1 to 12/31 to 93,333, my second useful year estimate. So we don't have the same estimates for my first useful year and my second useful year, unlike was the case with straight line depreciation. So that makes now this weighting more relevant when we're doing partial periods. So 116,667 times basically 3/4 gives me, and I'm rounding it, 87,500 plus 93,333 times a quarter, and I'll round again, 23,333. Add those two together, and I get for the depreciation expense in calendar year 2, that would be 110,833. I'll take it one more year. So now we've used up 3 months of that second useful year estimate. There's still 9 months of it remaining to exhaust that. So we're going to take 93,333, multiply it by 9/12. That gives me the useful, the months December 31st to October 1st during the second useful year and third calendar year. And then I switch over to the third useful year estimate in these last 3 months, 70,000. So we've already done 70,000 times 3/12. We know that's 17,500 from the top example. It's the same, it just happened to be the same depreciation estimate as our straight line. And we take 93,333, multiply it by 75%. And it actually comes out to something very close to 70,000, 69,999.75. So we'll just round that. 87,500 is the depreciation expense for calendar year 3. So that's the partial method, and it's partial because it's just assigning a portion of each useful year's estimation, depreciation estimate, to a calendar year based on how long it has. So for the first 3 months, it's the first useful year's estimates times the 3 months because we bought it in October. Well, we only recognize 3 months of that first year's estimate. So then the next year, we're going to have 9/12 of it remaining before we move into the second year useful year's estimate. I know it gets very tongue-tied thinking about calendar years and useful years, but if you walk through it a few times, maybe use your own terminology, your own way of explaining it to yourself, so that you understand how these expenses are getting allocated out over the time. Hey, that's exactly what I want you to consider. So that's partial period. And if you think about the real world, we're buying and selling assets, not necessarily on even dates like October 1st or August 1st or the beginning of the year or the end of the year. Those are very nice canned examples because they don't require a lot of complex calculations. But if you were to buy an asset, let's say like September 10th, and you needed a partial, you would kind of have to start, counting the day. You'd have to have the days between September 10th and December 31st. And that would be your first portion. And then your second portion would be January 1st to September 10th of the next year. It would just get a little bit arbitrary and tedious. And so what we've allowed, what we use is a simplifying, and in many cases, a simplifying assumption to deal with partial periods. We use either the half-year convention or the modified half-year convention. And so the half-year convention assumes that all assets were basically acquired on July 1st. No matter when we acquired them, They were acquired on July 1st. And what that does is it eases the computation a bit, because instead of having to worry about 3/12 and then 9/12 and then 3/12 and then 9/12 and then 3/12, all of those turn into 6/12, right? So basically what we do is, instead of thinking, okay, I bought it on 10/1 and now I have 12/31, I treat it as if I bought it on 7/1, and then 12/31 is 6 months away. And then the first useful year ends on 7/1 of the following year. So useful year one, now instead of kind of bridging 3/12 of this year and 9/12 of the following calendar year, it's 1/2 in the year of acquisition and 1/2 in the following calendar year. It splits it up evenly. Oops, sorry. This is calendar year one. And then this is calendar year two. So how would this affect our calculations? Looking at, the straight line will never change, but looking at this one, now instead of needing the sum of the year's digits, we would just take 166,667, multiply it by 6/12 or 1/2. And that would be my first calendar year. My second calendar year would be 16667, because only half of it was recognized there. Half of it gets recognized for the first half of the second calendar year. I add in the second depreciation expense, the second year useful estimate, 93,333 times 6/12. And the math behind that, I can do that real quick. 667 divided by 2 gives me 83,334. That's my first calendar year's depreciation expense. That's what I would find on the income statement. Then, of course, it's nice because I can just use that calculation I just made. It's not 3/12 versus 9/12. It's just half and half. So it's always going to be there. Then I just do 93,333, divide that by 2. And that gets me 46,667. Add that back to 83,334. And it's $130,001. That's my second calendar year's depreciation expense. If I carried it over into the next calendar year, it would be 93,333. We still got 6 months of that left. And I would add to it, remember now, the third useful year, 70,000 times 1/2. And I get 46,667 plus 35,000 even. So that becomes 81,000. And that's my third calendar year's depreciation expense. So it just cleans up, it makes it easier. We don't have to worry about those fractions. And I mean, dealing with 3/12 and 9/12, that isn't that bad. But like I mentioned, if you ended up buying something on September 10th, then you would have, a portion of a year that's not clean at all. And then, basically 1 minus that portion in the next year. So the half just starts to make it a little bit easier because we are just taking half of everything. That's an easy calculation. Then we have an even more simplified. Is it 116? Oh, it is 116. My apologies. I don't know why I started getting off on 1666. Thank you for pointing that out. So that'll change a couple of the calculations just to be perfectly accurate. Let me do that. 58,333 or 334 when I round. And 116 times that is the same, of course, 58,334. And add 46, 667. Oops, 105,000. All right. Yep. So that's where it was not 16667. It should be 116,000. Thank you for bringing that to my attention. All right, so with that, that's a half year. Modified half year actually even makes it simpler. Any asset that was purchased during the first half of the year, we act like we recorded it on January 1st. Any asset that was bought during the second half of the year, we act like we bought that at 12/31. So it becomes even simpler than the half year assumption. For example, how would that change with the example we used with partial periods? Instead of, since I bought it on October 1st, I would then assume, all right, October 1st is the acquisition, is the acquisition date. But if I used a modified half year, I assume that I bought it on 12/31 of that year. So it moves that acquisition date rather than to the middle of the year, it moves it to one of the extremes. It either moves it to the end of the year, or if it's prior to July, then it moves it to the beginning of the year. And what happens is, as a result, the calendar years and the useful years align perfectly. So this would be, because we're pretending like we bought it at the end of the year since it was bought on October, which is after 7/1, then this is calendar year 1. And this would be where I have my useful year 1 estimate. This is calendar year 2. This is where I would have my useful year 2 estimates. So now we would recognize $0 of depreciation in this year, even though I acquired it on 10/1 under the modified half year convention. I assume I didn't buy it to 12/31, so there's no depreciation expense to recognize. Then in the first useful year, which matches this calendar year, right, I just recognized the full amount, 116,667 for the sum of the year's digits. For that next year, it's just the second useful year, 93,333. So then there's absolutely no dividing things up. It's just whether I count $0 of depreciation in that year of acquisition, or I use a full year. And if I would use the full year, if I had bought it prior to 7/1. So let's say that in actuality, instead of October 1st, I bought it on March 1st. That was the actual acquisition date. Well, because March is before July, I would bring it back to and pretend like I bought it on 1/1. And so then this becomes calendar year 1, and I would record all my first useful year that year because I'm pretending like I bought it on January 1st. And then for year 2, this becomes 93,333. And for year 3, that would be 70,000. So both of these modifications are very much prevalent in practice because depreciation, all we're doing is matching. We don't need it to be an exact science, if you will. It's okay that, in this example, I bought it on 10/1, but I'm not recognizing 3 months of depreciation this year. Well, that's okay, because I'm going to end up recognizing it in the future, one way or the other. And that tiny amount of 3 months of depreciation on a single fixed asset doesn't really end up being a material amount for us to worry about. And so both of these are extremely, like I said, extremely popular in practice. It keeps the calculation simple for something that doesn't need to be overly complicated or exact. Right. There are some examples that I posted of these in the problems that I posted. Those two would be very good to work. They're in the chapter 11 module. I will share my screen real quick. Yeah, here it is. It's case number 4 and number 5. These two guys right here. Both of them have you walk through providing the half year, modified half year, or the partial half year, modified half year. And you should be able to do that. Even though, like I mentioned, McGraw-Hill does not have any examples using these simplifying conventions in their problems. And I thought that that was a huge oversight, because I think that, if it's done in practice, it really should be something that you're familiar with, and it just makes our lives easier. It's a good thing that it's done in practice, because we don't have all these tedious calculations with partial periods. So definitely recommend doing those prior to the next exam. Any questions?